Welcome to this screencast. We're looking at the cash flow forecast table. The cash flow forecast table is when the business is trying to predict how much money will be at the end of a month, looking into future months. For your GCSE exam, you're quite likely to get a table just like this one with some missing figures that you need to calculate. And to do that, you need to know what each row represents. Trouble is, accountants use special words to describe, in this case, cash coming into the business. So this is an inflow of money into the business. And this example, the only way the business has money going into it is by selling its product. So whatever you get here will be your total receipt, total inflow into the business. And in case of April, they give you the total receipts, and you just need to copy that figure over here, because this business only gets money coming in from selling. So this is for the inflows. Now we need to look at the outflows. Cash outs, helpful to have that here, but you need to remember what this means. Purchase, when the business is buying raw material, and then the rent maybe for a corner shop. You add those two numbers together to give you the total outflow. So this is your total outflow. 13,000 plus 2,000, 15,000. It's very useful when you got this column there. You can actually work out what's going on. The net cash flow is in, the total in, take away the total out. 5,000, take away 15,000. In January, the business has spent more money than it earned, so you got a negative cash flow, and the difference is 10,000. Finally, you add the net cash flow to the opening balance to get the closing balance. £1,000 add minus 10,000 is minus 9,000. We now repeat this for the next month. Here we've got our total outflow is going to be 3,250. You take away the total outflow from the total inflow to give you the net cash flow, 4,250, and you can check it now that you've got the numbers. You add your net cash flow to the opening balance. So the net cash flow is positive, but not quite enough to bring the closing balance into positive, and we've got minus 4,750 here, but the situation is improving for this business. This is good. In March, we can calculate the rent by taking away 2,500 from the total outflow, but we can also notice that the rent is the same every month. If it changes, it's going to change once a year typically. 9,000 for total inflow, take away the total outflow, 4,500 is 4,500 as well, which we add to our opening balance. Now, the opening balance in March is the same amount of money as the closing balance the month before in February. So here, it's 4,750. And we end up with a closing balance of minus 250. So situation is still improving. 8,000 total inflow, 4,000 total outflow, giving us a net cash flow of 4,000, which we add to our opening balance, giving us a closing balance positive, this time of 3,750. Here is another example with fewer, not so much help to help you make sense of what this is. And you need to remember that receipts is inflow, raw material is out, fixed cost is out, total payment is adding together your total out. So in this example, you add together 1,070 and 1,900. So you had 2,970 for the total payment. You do not add the receipt. What you need to do as this is the only inflow in this business, so this is in fact your total inflows, you take away 2,970 from 3,590, giving you a net cash flow of 620. We don't know the opening balance. They do give us the closing balance for September, which is the same amount of money as the closing balance for August. So here we've got 4,090. Now to calculate the opening balance, we need to take away 620 from 4,090. So when we do this, why do we need to do this? Because we know that closing balance is opening balance add the net cash flow. So the closing is 4,090, the net cash flow is 620, and the opening, if we do the calculation, is going to be 3,470. So I can put here 3,470. And to finish, we need the net cash flow, which is receipts, 2,190, take away the total outflows, and this time it's negative 560. We add this negative 560 to our opening balance, giving us a closing balance of 3,530. So remember, you need to know that receipts means cash in from selling your material. You calculate your total inflow by adding together all the different ways in which the money has got, the business has got money coming in. Every month they got to sell something. There might be some month where they've got a bank loan. There may be some month where they got a grant from a government. And then the last one you need to know about is if there's some investor money coming into the business. Outflows, you're going to have purchasing the raw materials, you're going to have rents, you're going to have fixed cost, you're going to have variable cost, you're going to have all kinds of utility bills as well. And you add that together for your total outflow. Net cash flow is in, take away, out. You add this to the opening balance to get the closing balance for this month. And your closing balance for the month becomes the opening balance for the following months. Learn all of this, keep on practicing with these tables, and I look forward to seeing your work in the lessons.